This analysis is solely my own. It is for educational purposes only and does not constitute an investment recommendation. The companies driving the computing economy, Apple, Nvidia, AMD, draw highly complex blueprints. However, they lack the facilities to actually build the silicon they design. Those designs are handed off to a single entity headquartered in Taiwan, Taiwan Semiconductor Manufacturing Company, or TSMC. The scale of this operation is staggering. Every year, TSMC processes roughly 17 million silicon wafers. In the leading-edge segment, the 7-nanometer nodes and below, where AI performance is determined, TSMC controls about 90% of the global market. The manufacturing layer serves as the indispensable foundation of the AI economy, providing the physical capacity that allows software and design breakthroughs to function in the real world. This dominance began with a structural choice in 1987. Founder Morris Chang established a pure-play model: manufacture chips for third parties, never design your own. This model eliminated channel conflict. It allowed hyper-competitive rivals to hand over their most guarded intellectual property to TSMC, knowing the manufacturer would never use those secrets to build a competing device. TSMC sells yield, the exact probability that the individual chips cut from a raw silicon wafer will actually function. Processing a highly advanced wafer costs practically the same whether 60% or 95% of the chips work. By guaranteeing that higher success rate, TSMC produces nearly 60% more sellable silicon, making yield their ultimate value proposition. This arrangement transfers the industrial risk to TSMC. If a wafer is ruined during the hundreds of required chemical steps, TSMC takes the financial loss. But because the company is paid per wafer processed, they avoid the market risk of whether a client's final product actually sells to consumers. By focusing on manufacturing reliability rather than end-market success, TSMC stays insulated from the volatility of individual product cycles. This chart shows TSMC's growth engine uses 3 levers: increasing wafer volume, migrating to advanced nodes, and raising prices. In fiscal 2025, revenue jumped nearly 40%, with almost half coming from price and node migration, as clients accepted hikes for leading-edge capacity. This stacked bar chart tracks TSMC's revenue mix. The business is rapidly concentrating in high-performance computing, or HPC, which expanded to represent 61% of total revenue as of early 2026. This concentration has created a secondary bottleneck in advanced packaging, or CoWoS. AI chips require logic and memory to be stacked together in a single integrated system, a service that is currently sold out. This capability gives TSMC new commercial leverage. To build a leading AI accelerator, a customer now needs to secure both the raw wafer and the specialized packaging from the same provider. TSMC has effectively transitioned from a diversified foundry into a highly leveraged bottleneck for the entire global AI build-out. This chart tracks TSMC's margins through early 2026. Surging AI demand pushed gross margins to a record peak of over 66%, leading management to raise their long-term structural margin target from 53% to 56%. However, maintaining this position requires immense capital. A single lithography machine can cost $350 million, and TSMC must commit between $40 and $56 billion in self-funded spending every year just to stay at the leading edge. This creates a CapEx trap. If the AI cycle cools and factory utilization drops below 85%, TSMC is still on the hook for over $22 billion in annual depreciation. Those fixed costs continue to run against lower revenue, which can rapidly erode profit margins. While cyclicality is a standard risk in semiconductors, TSMC faces a second, more binary vulnerability. Over 90% of the company's leading-edge manufacturing capacity is concentrated on the island of Taiwan. This geographic concentration places the entire operation under a permanent geopolitical shadow. Unlike the recoverable risks of a typical economic down cycle, a disruption in the Taiwan Strait represents a near-total loss risk for the business. TSMC currently operates as the central infrastructure of the global silicon supply chain, but its high fixed costs and geographic isolation mean the business remains uniquely tied to the stability of the cycle and the region it occupies.